this was not tinfoil conspiracy stuff. There
No, they
really
actually
was.
had a rule. They admitted, hey, we had a policy, and not religious groups, because they did it for Muslim groups. They did it for other groups. No problem. But if you were a conservative Christian or Catholic group, you got put onto the back of the file, and it would take 9 months, if they approved you on average, to get a bank account open.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, a couple times, we'll get to the news, of course, but a couple times a year, you put on a seminar called Tax Mastermind, and this is one of those times. In fact, one of the participants is going to join us in the second segment of the show. Just give us a quick rundown on the Tax Mastermind seminar.
Yeah, so we've been doing these for, I guess, our 6th year doing these a couple of times a year, typically, where we host 1 or 2 dozen or so advisors from all over the country. These are typically independent fiduciary advisors, very similar to us, that are seeking better tax education, tax knowledge that they can go back and implement with their clients to give their clients more of their hard-earned retirement savings. And so we've been blessed to do it. We get great feedback every time we do it. And, we believe, like we do with our advisors here, iron sharpens iron. So bring together a collaborative, and the outcomes are phenomenal. So we're really excited to host them, and we get to treat them to the best piece of red meat they typically have. So we always have to ask on the questionnaire when people sign up to come. Are you a vegetarian or a vegan? It's okay. We just need to know.
So that'd be about 20 people, right?
Yeah,
coming in for good. All right. Well, we'll hear from one of the participants, as I said, in the second segment. All right, into the news we go, David. Wow, you sent me this story from CNBC. The headline is, so the phrase is, invest like the 1%. That was the slogan this company was using. And so the headline is, when invest like the 1% fails, how Yieldstreet's real estate bets left customers with massive losses. Now, I know you love real estate as an investment, but there are pages and pages, example after example, of people getting hit with $6 and $7 million losses.
Well, we've talked about the corporate real estate market has been in pain. We talked about it right on this show. I don't know, a month ago, I sent you 2 office buildings that sold for a total of $12 million in downtown Denver in the tech center, right? South of Denver, real estate selling for, less than a lease might have been for 10 years of one floor of one of those office buildings. And that's all over the country. We had the San Francisco examples. We've been covering it for the last 2 years. Well, real estate is a phenomenal investment. However, it's an illiquid investment. And so this tagline of invest like the 1%, what this company was doing is trying to use it as a marketing ploy to entice people. And it's true. The uber wealthy, those that have at least 10 million or more in liquid net worth, about 53% of their assets, Chip, are in non-publicly traded investments, non-liquid investments. Center city real estate, multifamily real estate, private equity, private credit. They own things that they don't price every day, right? And they're not in a panic when they need to access their money. The problem is this company, Yieldstreet, tried to go after the mass affluent and tease them like, hey, we'll get you into these investments that the wealthy get. Well, the wealthy have some luxury. A lot of other folks don't, Chip. They don't need liquidity. They don't need access to their funds. And real estate and other investments like this are very long-term plays. And we do. We offer very unique alternative liquid and illiquid investments to our properly accredited investors, what's called a accredited or a qualified investor. That means you have at least $1 million to be accredited in liquid assets or over $5 million for a qualified. That's who these type of investments are meant to be for. And you still have to make sure they have enough liquidity for their lives, their income needs, et cetera. This company kind of, they didn't do their due diligence on each client. They just took the cash and bought some real estate that was some of the examples we just talked about that got crushed in value, 60, 70, 80%. I was reading the story. There was one example where a gentleman who had only about $800,000 in savings, so he should not have been in the investment to begin with, lost over $400,000. So, this is kind of stuff that people should go to jail for, frankly. And sadly, though, the company will end up probably bankrupt, so you can sue, but the only one going to get paid probably out of that is the trustee, is the attorneys in some kind of class action lawsuit.
It's enticing because, as the story says, their pitch line is, we're going to democratize access to real estate investing. We're going to let the little guy play in the same arena with the big guys but you can get crushed if you do that.
We have the alternative investments now available. Like, we can get people access to the NFL, right? NFL started allowing private equity just a year and a half ago. And so that's in some of the investments we have for clients. But you're not getting, and it's a slither of a share. Let's be mindful, but it's fun to say you're an owner, maybe of the Buffalo Bills, what have you. But you need to understand is what comes with that, though, is you're not getting out of that investment. It's not like, hey, tomorrow I'd like to cash that out. No, there are exit points, typically years sometimes with some of these illiquid investments. You have to commit your capital 10, 12, 15 years. But it is true. That is how the wealthy truly get wealthier, because the way wealth is created in this country, and again, this is what we need to teach young people, is assets appreciate over time. That's due to inflation. Inflation rises assets, gold, silver, stocks, bonds, real estate, houses, but all you have to buy them, but you have to be willing to hold them for a long period of time. And that's why they're typically only for people that have more than enough liquid cash available.
Be careful, do-it-yourselfers, caveat emptor, buyer beware. All right, David, Fortune magazine headline, perfect storm to hit Obamacare. Millions could see premiums surge 75% in 2026. Now, wait a minute. Obamacare is already incredibly expensive. What is going to drive this new surge?
Oh, you want to call it by its real name? The Affordable Care Act?
Yeah, right.
Anything but. So premiums are up 670%. So over almost 7 times since that bill was passed in 2009, I believe. And here we are 15 years later, and you're paying 670% more. If that was nominal inflation, you'd only be paying about 25% more, right? And here they are. They want to push it another 75%. And insurers, over 312 insurers have filed and asked for over 25% increases, 180 of them for over 75% increases. I don't remember the exact numbers in there, but why is this? Well, you have to understand is this was padded with all these side subsidies to get the numbers passed, right? And you don't walk, there's a bridge that you will not walk on that crosses over from here to Iowa. So we always talk about it, right? So we happen to have a bridge, for those that don't know, that's a unique tourist feature here, but Chip Maxwell has never set foot on this bridge.
A monument to earmarks and pork and all the
because that was the Cornhusker kickback, right?
Right?
And that's what happened. Well, all this is coming due. You have to pay those bills. They were kicked down the road, and all those bills are coming due, and so the subsidies are drying up that would fund the bill. So again, to solve this, it's very simple, but logic and reason are not used in the political world. Stop trying to cover everyday health care with health insurance. Insurance means to indemnify you of an unexpected loss. Daily healthcare is not unexpected. So we should go back to indemnity policies where maybe the insurance only kicks in above $20,000 or $25,000 threshold. And then we could create healthcare memberships, right? That's how my wife and I, we pay a doctor a couple dollars a month and we have access anytime we want to them. We need to get back to doing that where you get your basic healthcare for a membership. And employers would love this, frankly, because it'd be much cheaper.
More of a market dynamic.
Yeah, I could buy a membership for my employees, and then the insurance premiums would drastically shop because it's really only for the crucial stuff. But anyway, that's, logic, just goes out the window in politics.
The Cornhusker kickback was actually a sweetheart Medicaid deal for Nebraska, but that Cary Bridge is the same species of Washington operation. But I won't go down that road, at least not today. David, here's a headline from the New York Post. Bank of America. This is a chaser, actually. We talked about this last week, about this debanking phenomenon. Bank of America finally axes rule that sparked debanking of conservative religious groups. This was not tinfoil conspiracy stuff. They
actually had a rule. They admitted, hey, we had a policy, and not religious groups, because they did it for Muslim groups. They did it for other groups. No problem. But if you were a conservative Christian or Catholic group, you got put onto the back of the file, and it would take 9 months, if they approved you on average, to get a bank account open. I mean, it's absolutely preposterous that this took place. And again, I just think, we should have a fair playing field for everybody. We shouldn't pick winners. And like this week, I don't know if you saw it, but now Trump's team's out there touting, we're going to get 10% of Intel. They want Intel to give them 10% of their stock to benefit from a CHIPS Act. No, here we go. I didn't like it when Obama did it. I certainly am not going to like it when Trump does it. We should not be trying to pick winners and losers. It's nonsense. Stay out of the way. We need smaller government.
Well, and I just want people to know we practice what we preach here, David. Now, you like to say, look, folks, I vote generally with my right hand, and Jesus Christ is my Lord and Savior. I just like to put that out there. I'll work with anybody. I'll help it. We have same-sex couples who are clients
tons
of
of
Retire
them, yeah.
Smart. And so and that's the way America should work. We're glad to work with you on retirement planning. We don't care about your politics and other things.
Well,
that's been the beauty. That's been the secret sauce of America over the decades
you and I,
the
we talk
centuries.
politics on this show a lot because it matters, right? The way people vote will affect our constituents, our clients,
it has economic
our
and financial
audience.
implications, of course.
So as I say all the time, I don't really care about the person, or excuse me, I don't care about the party or the person. I care about the policy. What policies will they enact, vote for, or bring to the table to enact that will benefit, my clients and our listening audience? So, I mean, it's pretty simple, but again, simple and logic, they don't really work.
David, you sent the team some info here on sales growth, or lack thereof, for restaurants and bars over the last 3 months. I thought summertime was like peak activity for restaurants and bars, but according to this chart, that ain't the case.
Yeah, so we're seeing people are pulling back mightily. Now, here's the funny thing is fast food's really taking it on the chin. So you would think that fast food would pick up when people tighten the wallet, but fast casual dining, kind of like where you would go to a TGI Fridays or an Applebee's style, is doing much better relative to the fast food chains, McDonald's and Arby's, et cetera. And you would think it would be the opposite. However, they are, even the fast casual is what I'm showing you, the bars and restaurants, a massive drop the last two quarters. And so this is telling you America is getting tapped out. We've been talking about this. The stimulus money has run out finally, and folks are having to tighten the belt, and that's going to lead to an economic slowdown. And unfortunately, I think you're going to see worse job numbers as the year goes on. As much as I want to tout, hey, do we still have a thriving economy? I'm a little nervous right now on where we sit.
So this is that dichotomy we've seen for a while now. The market's roaring and so forth, but the underlying economic fundamentals maybe not as solid.
Yeah, and we talked about that last week, the valuations being rich. Well, the market has started a decent little pullback here. We'll see if it actually turns into what we call a correction or so, or just a little dip. But, again, the point for the listening audience is just make sure you understand the amount of risk you're currently taking.
Up next, several times a year, Retire Smart puts on the Tax Mastermind seminar. One of the participants joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David Brooks is a nationally recognized leader in the financial industry, especially when it comes to tax planning. Advisors from around the country are with us this week at Retire Smart, and one of them joins us now. David, please welcome Chris Wooten of Wooten Financial Group from Conroe, Texas.
Thank you, Chip. Yes, in the studio, we have a very special guest, Chris Wooten of Wooten Financial Group out of Texas, just a little bit north of Houston. So, Chris, thanks for joining us here in Omaha.
Thanks for having me on.
Well, we're really excited because tonight I'm going to take you. I know you guys can do some decent brisket down your way, but we're going to take you for the best steak of your life, I think, tonight. I'm making a prediction. So, hey, we are really glad to have you in studio today. So just tell our listening audience a little bit about your firm and kind of how long you've been in this business. I've been doing this almost 27 years now. Yeah. So,
well, I'm a little younger in terms of how long I've been in the industry. So about 20 years in the industry. The firm was originally owned by its original owner. It's been in business about 30 years. I've been with it about half of that, and then I bought it 10 years ago from the original owner. But we're a small boutique practice just kind of north of Houston in the Woodlands, Conroe area, and comprehensive financial planning and wealth management.
Now, not to get off on a tangent, but you boys, you kind of take your football a little seriously down those parts.
We tend to, yes.
We're a little excited here, Go Big Red here. And we are now an actual official sponsor of our beloved Cornhuskers here.
Fantastic.
But a little birdie told me you were partial to an A&M fan. You were an Aggie fan.
I am an A&M fan, which right now is not a good place to be. So,
well, you can keep your current athletic director. We have some thoughts on that. But anyway, he was a wonderful player for us. But
I can't say I'm a fan of everything they choose to do, but
well, I will tell you though, that school has cash flow. It really does. Its fan base and its alumni support it very well. So if they're not doing good today, don't worry, they'll buy a team and then current rules pretty quick.
Well, for all that's worth, even though UT is not my team, I think UT is going to have a good year this year.
Yeah, well, so speaking of that, right? So these money some of these kids are getting. Of course, Archie Manning made, I think, a little over $3.8 million, something like that, last year riding the bench, right, as a college athlete. Meanwhile, Brock Purdy, who's been one of the top 5 quarterbacks in the league for the last 4 years, made under $900,000 last year. year, right? For the San Francisco 49ers. But yeah, so money complicates things, right? And I imagine in your part, you probably have a lot of people that are tied to oil and gas industry potentially, right? And so they bring up some unique situations. So let's talk about why you came to Omaha. You are here to attend one of the 2 tax masterminds we put on every year. So how did you hear about the tax mastermind, and what do you hope to get out of it while you're here in Omaha?
Well, I actually heard about it about 3 years ago. Had planned on coming last year.
So you're a procrastinator.
Well, we just had some pretty major life events happen to our family last year, and so I just wasn't able to come. But so I'm excited about learning some higher level tax strategy that tax planning is an important part, right?
It really is
of what you and I do.
Yes, absolutely.
I won't say I'm tax myopic, but it is a very important and a big piece of the overall retirement.
Yeah, I mean, we work with a couple of firms down your way, and in your marketplace, because you end up with people with like RSUs, restricted stock units for large publicly traded oil and gas companies, and these create tax nightmares because they end up getting to sometimes 40, 50, 60% of someone's net worth. And you were talking $5-6 million. They're stepping into retirement feeling they've made it, but they have this massive 7-figure tax bill no one's kind of warned them about or planned for.
And they're totally unaware of it.
Yeah, absolutely. And then they end up paying other taxes, Medicare penalties, and all kinds of stuff. So
the other big thing we see is deferred comp.
Oh, yeah, absolutely.
And most people, when they choose their payout on deferred comp, they're just willy-nilly. I mean, and that's a huge
Look over
problem.
next to Fred, who signed up at the same time. Oh, yeah, what'd you choose? I'll choose that, you know? And, and these have major consequences on the backside of it. So, so we're excited to have you here. We're going to go through at least 3 or 4 dozen strategies while you're here, but we train on about 160 different tax strategies at our mastermind. And it's complex. Some of them are not needed but for very rare and unique situations, but I just can't help to talk about how important it is for our listening audience to understand there are over 1,700 incentives embedded in our tax code today to reduce somebody's tax liability. And if it wasn't that way, because people think, oh, they're tax cheats. No, these are incentives Congress has put in place to help you do certain things, certain behavior, and you get a tax break from it.
Absolutely.
Charitable giving is a simple example of that. Why do we give tax breaks when you give to charities? Well, charities do the work that the government doesn't have to do. Feeding homeless, right? Backpacks for kids. There's a myriad of different charitable organizations, and they're more efficacious. In other words, they take the dollar and stretch it farther, so the government benefits immensely for giving these tax breaks. So again, taking that concept to a whole nother level is what we do when we have these restricted stock units, deferred compensation we have to worry about. There are so many things in the tax code that can help your clients do better and help society do better. So we're really excited to have you in here.
Well, let me tell you, I want to thank you publicly and just tell you I have a tremendous amount of respect for you, for your knowledge base and what you do. I'm excited to be here.
Well, I've been blessed to help 600-700 advisors across the country in my career. And I just, it started as like a small group at a conference somewhere. I started sharing some ideas, and next thing you know, turned into more, and I got people calling me. Then we had people coming and do office visits. So then I guess it was almost 6 years ago, we hosted our first mastermind. So all right, we'll charge you a tuition or something, and I'll have you come in for a couple of days. And from that, it grew, and we never advertised these. It just kind of word of mouth spreads, and we've got a full group. I think 18 of you in today. But anyway, it's a lot of fun. And I had another advisor ask me, well, why do you help all these other advisors? Aren't they your competitors? I'm like, no, we can't serve everybody. And we serve currently just under 1,000 families here in the major Omaha and Lincoln area. And we have clients in multiple states, but we can't get to everybody. Right. And, so I said, there is no competition. I want to help and serve as many people. And the way I can do that is live in the world of abundance. If I help other advisors get sharper, get better tax planning, that's more money into our economy, which means our economy grows, the country benefits, on and on. So anyway, it's so rewarding to me to be able to benefit and help other advisors. Wow. And the coolest thing is when we get the messages back, the thank yous, and oh my gosh, thank you so much. You helped me on this. I was able to provide an unbelievable amount of value to a client that I didn't have the tool for before. So that's a lot of fun. So speaking of your practice, so how many people do you guys employ? What size is the firm?
Well, so we've got 5 total employees.
That is nice. There's nothing wrong with that. Payroll doesn't make you sweat like mine does.
and so we're, in terms of growth and so forth, we obviously have goals, right? I'm still at a place where I'm not sure I want to be as big as some
right size your firm. I talk that all the time. You don't need to build a big. You don't need 50 employees. You need. I tell what I always tell people is prospective clients listening to the show or on YouTube or radio is when you're working with somebody, I recommend you find an independent fiduciary-based advisor. Yeah. You should talk to them, ask them about their experience, whatever credentials they have. Make sure they're a fit for you. And then make sure you understand how they disclose how they get paid. And there's various ways that advisors get paid. And all of them are appropriate if done correctly. You simply need to know. It needs to be transparent, right?
Sure.
And so I just think that's so important that people understand. Working with a smaller firm, you have backing of large custodians and things. So you're not really out there. It's not like this one-man shop sitting there,
Sure.
And so I think it's really important people understand, too, working with small firms can be perfectly appropriate because they can niche and give sometimes a much higher level of client service and things like that. So so what do you really hope to get out of this? So when you go home in a couple of days, what would make this trip to Omaha a success?
Well, obviously,
for you?
my goal is to be able to better serve our clients, right? Our tagline for our company, if you will, is clear direction for retirement, right? So the clearer somebody can be on how taxes work, where they may have a problem, and what is the best solution to go solve that problem, to me, bringing them clear direction is what we're all about. So
no, I'm a pretty good marketer. So I'm telling you, after you give somebody that clear direction, I think you should hire like cheerleaders from the local high school when they come out of the conference and they go, woot, woot, right, for Wooten Financial. You're retired.
That's right. Exactly.
Well, listen, we're blessed to have you in here. Hopefully you have a fantastic week at the Mastermind and learn something and benefit. We are out of time for this segment. Thanks for jumping on the show with us.
Thanks for having me.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, we will get into the Q&A, David. I just want to know, when I first shook hands with Chris Wooten, I sensed a redeeming quality about him. I couldn't put my finger on it. But when I heard he's a horns down Gig'em, Texas A&M fan, that settled it for me. All right, into the Q&A we go. First question, David, is about the financial planning field in general. I've seen news articles about reductions in employees and assets at well-known financial firms such as UBS and Edward Jones. Is this an industry-wide slump? Are you struggling at Retire Smart?
Well, I appreciate the question. No, we are not struggling. In fact, I
can't keep track
we're on pace.
of all the new people.
Yeah, we just hit fastest growing companies in America for the fourth
year in
consecutive
a row.
year. Less than 400 companies we were told have ever achieved that. So, no, not struggling at all. And in fact, our industry is actually doing well. What you're seeing is a massive transition away from what we used to call the wirehouses. When I started my career at Payne Weber, which UBS bought, by the way, and we're seeing a shift of advisors leaving the big boxes and going to the RIA space, Registered Investment Advisor. Because when you work as a Registered Investment Advisor, we're working under the Investment Advisory Act of 1940, which means we charge for advice, not transactions. Where when you are securities licensed, like I used to be with Series 7, 9, 10, 24, all these licenses, you got compensated by the transaction itself. When I started, if you bought a stock from me, and Disney was the popular stock because I was in downtown Orlando, right? You want to buy 100 shares of Disney, the minimum commission I could charge was about $375 at Payne Weber, right? Back in the 90s. And this is before the advent of online trading like it is available today. And so the advice was complimentary, the transactions what you paid for. Well, most people prefer just the opposite. I'll pay you for the advice, and the transactions are generally complimentary now. So, but yeah, you're seeing an exodus from these big firms. And the reason for that, Chip, is there's great people there. I have friends, just to put this out there. There's good firms and there's great people at them. But they're handcuffed a bit. They can only offer what is on the product distribution approved list of that mothership, right? Like there's an approved list of mutual funds or investments they can offer for their clients, and they're beholden to only saying what the firm allows them to say. So go to one of those type of firms, and you're probably not going to get proactive tax planning because I don't think the firm will allow them to do it. So there's a myriad of reasons for this, and we're just seeing a transition in industry to companies like ours. But thank you for asking. No, we're not struggling at all. In fact, we continue to grow, our 8th consecutive record year since starting.
Next question, David, is about investor market return. I saw a news story about a study by J.P. Morgan Chase. It said that from 2002 to 2021, the S&P 500 went up 9.5% per year. But then it said that in that same time frame, the return for the average investor increased only 3.6%. That's not even half of the annual performance of the S&P. How does that happen?
Well, it's a reality. Delbar does a study very similar to puts that out every year as well and has very similar results, sadly, where the average investor does typically only 40 to 50% of what the general markets do. Now, there's a myriad of reasons for this. They do not have the education or understanding of how to build a truly diversified portfolio. So investors sometimes go all in on one theory or one position, if you will. And then when that one corrects and things do, right, then they panic and they typically make emotional decisions with those dollars, the individual investor, unwinding all the gains they may have had over a long period of time. I mean,
so we're talking about the do-it-yourselfer at his kitchen table.
Yes, yes.
Okay.
And so they make bad decisions. They try to time the market. And true wealth, as we just talked about earlier, it's long-term investments. That's how the wealthy invest in those things we were talking about earlier in the show. Well, it's not timing the market, it's time in the market, right? And so you need to stay invested. Charlie Munger, the great Charlie Munger, who passed away last year, one of his favorite quotes I love, and I'm paraphrasing exactly. He goes, "The only thing you don't want to do with compounding is interrupt it, right? You want
stay out of the way,
get out of the way, and let your assets compound over time. But individuals try to outsmart themselves, and it costs them dearly. On top of that, they do not understand some of the fees or expenses with certain types of investments they choose to go in, and it ends up costing them as well. And it's a great article out there. You can Google it and find it where it kind of gets into all the main factors there. But yeah, it's very true. The average investor does not keep up with the market.
Well, speaking of the late Charlie Munger, here's a question about the Buffett indicator. I've heard you talk about the Buffett indicator. Right now, it says the market is overvalued. What do you think? David, maybe you better first remind us what the Buffett indicator is, and then give us your take.
Yeah, so the Buffett indicator recently cleared, I think, 212% I saw. So the Buffett indicator is basically you take all the public traded stocks, and the one easy way to do this is the Wilshire 5000. It's an index of 5,000 largest publicly traded companies in America. Now, just so you understand, very different world today. When I started, there was over 11,000 publicly traded companies in America. Today, there's about half that. But you just take those and add up the market capitalization of all those companies. What is the value of that? And the Buffett indicator for years was, what is that equated to against our GDP, what we produce as a country? We're about a $27 trillion GDP producing nation. So if the value of the market is more than that, which it is, it's more than twice that. We're over 50 trillion in that means the market is overvalued. And Buffett used to say, hey, when the market's undervalued, the Wilshire number would be under the value of the GDP. You'd want to buy stocks for the long term. Now, it is not a timing indicator, just like we talked about. This is not needed we don't want to use this for market timing. Yes. So the question was, do I believe the market's overvalued? We measure the market valuation. We do over 23 different ways that you can measure valuation that we look at here. And all of them are saying the market is overvalued, whether you look at price to sales ratios, price to book ratios, PE ratios, what's called PEG ratios. There's a myriad of ways to do this. We like a capital markets assumption model. There's a different ways you can basically value what is the fair value. Now, fair value on the marketplace does not mean what the value is in the marketplace today to make a trade. So you do not want to use market valuation metrics to use to time, but it may tell you, hey, maybe the market's getting a little frothy here, Chip. And, maybe, obviously, did you hear that crash?
Right on cue.
Yeah, right on cue. Someone off camera. But anyway, and the coughs too. Hey, we can edit this whole section. So Chip, we don't want to use it as a timing mechanism, but yes, the market is overvalued, and that just tells us there may be a correction on the horizon, but we can't guarantee that, and nor would we use that as a marking timing on a daily number.
Well, stay tuned, folks, because some of those ratios that you just referenced, David, we're going to look into those in more detail in the next segment. In fact, we've got another Buffett-related item. Up next, indicators in the real estate market are somewhat shaky, yet the Oracle of Omaha is going long on housing. We'll explore that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, we have talked several times recently about the softening of the real estate market in Florida and in Texas, but you sent the team some information about how this is starting to spread nationwide.
Yeah, so we talked about real estate. The commercial has been in the pain for the last 2 or so years. This year, we talked about residential real estate would start to fade, and it is, especially in the markets where it was really frothy, Florida, Texas, Arizona, where people were migrating during the COVID great COVID migration from big, heavy tax states. They decided to migrate to states that were a little friendlier on freedoms and taxation both. And so what we've got up now for those of you watching on YouTube is a chart just showing you the price changes basically year over year and month over month in over 30 cities here. And so it's starting to get severe, right? And so again, I talk about all the time. I walk my dog every morning, and there's like 4 listings now in this couple of streets where I live. One of them has been on, the person purchased this home 2 years ago for $599,000, and it's listed for sale today for $625,000. It was like $675,000 6 months ago. Person has moved out of state. It's sitting there, and I kind of walk by. He should probably cut the grass if he wants to sell it. I'm like, it's starting to look, and that's the problem. Is properties sit on the market. People spend less money to keep them up. They start to lose their motivation. They get upset, and so they're mispriced, right? And so sadly, the person's probably thinking, "There's no way I should sell this property for less than I paid for it 2 years ago." Well, that's the reality. If you want to move your property, you may have to take a severe cut. But here's the thing: people don't think the problem through. If that person has a mortgage on said property, call it $2,500 a month, and they hang on to the property for another year, how much is that, Chip? That's $30,000, right? So if they just cut the price $25,000 and sold it today, they end up with more money than if they carried it for another year and got their asking price. So in other words, people need to start doing the math. And you're going to see some people that just run out of the capital to carry that second mortgage on a house. And we're also seeing the phenomenon of Airbnbs, right? So on the show today, we had, our buddy Mr. Wooten from Texas. Well, Texas is inundated with Airbnbs in certain marketplaces that are popping on the market outside of Dallas-Fort Worth area. The amount of listings that are popping up is insane. And so there's over 550,000 more listings today than you have people searching as buyers according to Realtor.com. That's a pretty big shift.
Meanwhile, you also sent the team information that rent prices are dropping aggressively. I guess that's good news for tenants, but not necessarily for the economy.
Well, so you're having, we had a massive build in multifamily, and those are coming on. And if you just look here, if you just drive out west, go out on 204, right? All the apartments you see out there's some new movie theaters and things, but those apartments are coming on faster, just out on West Dodge here. And they're coming on so fast that now they all have signs up where just 3 years ago, they would only have 1 or 2 available a month occupancy. Now there's apartments available everywhere. So the price cuts are starting to happen. I have an adult child who's looking, and they're much cheaper today than they were a year ago. $300-400 a month cheaper in some cases for a 2-bedroom apartment right here in Omaha. And in Florida, it's the same phenomenon. I have a 29-year-old that lives down there that's looking at some different space. And so we are seeing rents drop. This is a good thing for those that are affording, but there's never been such a gap between renting and owning, Chip. It is so much cheaper to rent today than own. And frankly, I wish I was renting my home. I've talked about it many times. It's just a house I live in, right? But my wife mandated that I own the home. When we went through it, she mandated I pay off a mortgage. It was only at 2%. I didn't want to do it. But anyway, happy wife, happy life, folks. But anyway, so I could rent a house like mine cheaper than it cost. My house is paid for, Chip. Cheaper than my property taxes, homeowners insurance, and maintenance upkeep on my house. I can rent a similar house here in Omaha. So why do I own the house? I could have that $600,000 plus working for me in another investment. So you need to do your homework if you're trying to buy a house. But the good news is the real estate market is starting to show signs of fading. And so if you are a first-time home buyer, it's going to get better. We've got another chart to show you the gap between new purchases.
This one, I could not get my head wrapped around.
Okay, so traditionally, when you buy a brand new home, you're going to pay 5 to 7% more than if you bought an existing home in a nearby neighborhood.
That
right?
makes sense to me.
Because you're getting brand new warranty on the house, the appliances are day one, et cetera. Where if you bought somebody's house that was 8 years old, 2 streets away, it's got some maintenance you might have to do, et cetera. So historically speaking, you always pay 5 to 7% more for a brand new home. That's not the case today. New houses are now, for the first time in history, Chip, nationwide cheaper than the average listing of the median home prices in most cities in America. So you can go. So that is a really big shot across the bow for those of you that have your house listed for sale. You're going to have to aggressively knock your price down if you really want to sell it in the next couple of months. Because why would you buy their house? And that's people are struggle to understand the market valuation. And I talk about
builders must be getting killed then.
But see,
builders
here's the
of
thing.
new homes.
Builders have already spent the money, Chip. So they have the house sitting there. When they built a spec home, if they've got $500,000 in this house, how do they get the cash out of that house? They sell it. Even if they cut the price 50 grand to move it and take a loss, it's better for them to have the 450 grand that they can go to work and do something with than have a $500,000 dead asset on their balance sheet. So builders are going to get very aggressive with incentives, closing costs, new upgrades, and you as the seller of just your single family home probably are not in the financial shape to be able to do that. So I literally had this discussion with a client last night. Basically, new relationship, him and his significant other just bought a house together, and they have two houses they're trying to sell. And he goes, what do? I said, price them right or hang on to them and rent them for the next 3 years. We're going to get through a bumpy real estate market. It's coming.
Okay, despite all these indicators we've gone through here, you also alerted the team to the fact that now we finally arrive at the Oracle of Omaha, Uncle Warren. Buffett has added some major home builders to his portfolio. What is going on here?
Yeah, so I believe he added DHI or DR Horton is the largest builder in America right now, and Lennar Homes in his latest quarterly filing. So he discloses what he does. He sold some Apple, give you an idea. So he sold off some more Apple, sold some Bank of America and some other things in there, and all this is public disclosure. But he made major purchases in these home builders. Now, that is a bet, in my opinion, of a aggressive rate cuts coming from the Federal Reserve, because those builders, if the rates get cut, just so you understand, most of these builders, when you buy, and we talk about the incentives to get said incentives, it's usually tied to you have to use their mortgage company. So they make a spread on the mortgage as well. If rates go down, their spread widens and it makes them profitable. So their lending arms of these companies, those divisions can become much more profitable. That's been not only unprofitable, but just downright losing money for the last 3 to 5 years in the mortgage industry. So those are going to swing back, and that's why he's making, and again, Buffett is smart and makes long-term value purchases. He's not doing this because, Chip, the home builders are going to skyrocket 20% between now and the end of the year. I don't believe that's the motive. I believe he's betting on the long haul, and they'll probably be adding to this position. Remember, they only disclose their positions to us once per quarter.
David, you mentioned in the third segment price to book ratio, and you sent the team several charts on price to book ratio, standard the S&P 500 price to book ratio, price to earnings. Sort through that for us. You folks on YouTube, you'll have several charts passing before your eyes. For the folks on radio, to the degree you can, use words to describe what's happening here.
So the first one we have up is what we call price to book ratio. So price to book, if we sold a company, not for its intangible, right, not for its goodwill and its brand name, its assets. Like if we were selling Retire Smart, it would be the camera that we're looking into, the microphone. These are our assets, right? Our desks, our furniture. These are things that are tangible that can be sold, right? So when you sell a company for book value, right, that's just the hard assets selling without a lot of future growth. You're not paying for any future growth of the company's revenue or earnings generation. So it typically doesn't sell for book value, but you can calculate the ratio of what their book value is based on their quarterly financials. Well, we are now above the highest in history price to book ratio. So it's just another metric of valuation, like we talked about with the questioner earlier. One way to price the market. Another way that I sent it out to you instead of price to book is price to sales ratio. So what we're looking at now is a PE ratio chart. So that's price to earnings. That's a very simple formula, Chip. If a company's stock is $10, Chip, and they earn $10 a year, right, in earnings, what's their price to earnings ratio? It'd be 10 to 1. You follow me?
Right.
If $100 a share and they earn $10, they're earning 10 times, right? So their price of their share is 10 times their earnings. That's a 10 to 1 PE ratio. Historically speaking, the S&P trades around 17 times earnings of all its companies combined. Well, we're over 22 times earnings right now. But when you look at the valuation, how stretched it is, the bulk of the companies are over 30 times earnings, right? And that's another way of saying the market may be getting ahead of itself. Are earnings going to grow fast enough to keep up to warrant this valuation? And that's perfectly normal. So sometimes the market doesn't have to always correct, Chip. Sometimes the market will do what we call base, and it'll just chop along for 3 to 5 months sideways until the earnings actually catch up to give it that valuation. But what I found interesting is how many companies there have a PE ratio less than 10. Out of all 500, the number is 1, Chip. There was one stock on that chart on the far left of it. Only one company. Now that makes me nervous. All 500 companies are not going gangbusters the exact same time. For instance, on Tuesday of this week, Chip, we had a down day in the markets, right? About 1% down day in the markets across the board, but over 65% of the companies had a positive day. So again, people get skewed by certain pieces of the news and the metrics. You need to understand how to value your portfolio properly. The lesson here is make sure you understand the amount of risk you're taking, what is your portfolio valued at, and what volatility can you expect going forward. And if you don't know how to do that, we have some tools we can complimentary do for you and show you what the volatility of your portfolio is.
David, in the final segment here of the show, final minutes of the show, some economics 101. Global millionaire migration. You sent the team some data showing that actually the United States is doing well. We've got people coming here. The UK is getting creamed. Give us some details.
Yeah, so this is millionaire migration across the globe in just this year, in 2025. And United Emirates, right, in the Middle East is the major benefactor. And that's because people from the Far East, from Russia, from Europe, from the U.S., et cetera, are migrating there because they are open for business ship, deregulation, very low taxation, and therefore they are attracting capital and millionaires to live there, which benefits their economy. Now, number 2 on this list is the United States. And that's one of the things Trump is trying to do, is to reshore the global elite to want to set up domiciles here because we benefit from their investments, right? And that's part of the big, beautiful bill, was to reduce tax liability on people so that they come here. And wealthy people do not sit on their cash, right? And so people always argue, oh, that Elon Musk has too much money. And I'm like, well, he doesn't really have money. It's value in all these companies he's formed, and he owns stock. And if he sold all that stock, right, and it turned it into cash, then he'd have money. But he doesn't, and he doesn't want to do that because he believes in the future value of those equities and those things that he owns. So again, people just don't understand how capitalism really works. We need to get back to teaching that in school. That would be nice. But anyway,
financial literacy.
You're seeing, company or countries suffer that are over regulatory, over taxation, and continue to push that way. And the UK is the prime example we are seeing, and people are leaving there in droves. France went through this a few years ago. If you remember, they put in a 75% wealth tax, and everybody fled. And they're like, oh, we were just kidding. I'm sorry. We can't do that. So again, the money flows where the regulation lets it go, right?
That'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week, and go Big Red Thursday night.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Chris Wooten and Wooten Financial Group are not clients of, nor are they affiliated with Retire Smart, and were not compensated for his appearance or endorsement. However, Chris Wooten is a consulting client of our affiliate Tax Smart and will also benefit from this show being released on Wooten Financial Group's social media platforms. Companies on the 2022, 2023, 2024, and 2025 Inc. 5000 lists are ranked according to the percentage of revenue growth from 2019 to 2022, 2020 to 2023, 2021 to 2024, and 2022 to 2025, respectively. The full 2022, 2023, 2024, and 2025 Inc. 5000 lists were published in August of each respective year. Smart Wealth paid Inc. magazine a non-refundable processing fee each year to be considered for inclusion on the Inc. 5000 list. The University of Nebraska and University of Nebraska Athletics, also known as Nebraska Cornhuskers, are not clients of Smart Wealth LLC nor Retire Smart LLC. Playfly Sports Properties, on behalf of the Nebraska Cornhuskers, was compensated for this endorsement, as such term is defined under SEC Rule 206, subsection 4-1. For further information about this sponsorship and the compensation details, visit retiresmartnow.com and click on the Sponsorships tab.